Happy 2025. So if your New Year's resolution is to start investing in 2025, then congratulations. You've just taken your first step to becoming an investor. Welcome to the club.
But in the club, we all fam. What? In the club, we all fam. In the club, we are all family.
Let's talk about why you haven't started yet. Usually what keeps most people away from investing, at least the people that want to invest that haven't started yet, is either two things. It's either fear of losing your money, fear of what happens in the market, or you just don't know what to do or what to invest in, which is also common. So let's start with fear, because it's very common where negative news stories or negative bias is giving so much more attention than positive stories. We will hear when the stock market crashes, but we rarely hear about it when it goes up. We will hear when a company crashes, but we won't hear about it when a company is doing really well, unless it's doing exceptionally well. But generally, that's what the brain does to keep us safe. Anyway, we're always looking out for threats. We are always looking out for the worst case possible scenario, rather than focusing on the good things, the positive things that might come from something. It's just your brain's way of keeping you safe, and it's completely normal. So fear is more likely to keep more people out of the stock market or starting to invest, or at least not taking it seriously. Because it's actually quite easy just to Google how to invest. The practicalities of it is so much easier. You can just Google what to do rather than taking that emotional leap and actually starting. So the biggest fear is really losing all your money, making a huge mistake, making the worst financial decision of your life, or investing one day and the stock market crashes the next. But how realistic is that fear? There is a market correction where the market drops around 10%, about once every 2 years. There's usually a bear market where the market will drop around 20%, once every 7 years. And then there's a massive crash where the stock market goes down by 30% or more, around once every 12 years. So these things can happen. But what about it going up? Well, marketindex.com.au did an interesting study recently, which is a great site, by the way. They looked at the past 124 years, so since the 1900s, and looked at the average of how the stock market went up. Now, this is the Australian stock market, but generally the markets around the world kind of mirror each other. So what this study showed is that on average, even including the crashes and the market corrections, the market does go up over time. In fact, it averaged 13% per annum over the long term. Now, this doesn't mean you have to invest for 124 years, but it does mean that over the long term, it generally goes up. So that's a positive thing. The second thing that most people are scared about is that they don't think they can choose the right companies, the right stocks. But the thing with the stock market is you don't have to be an elite player. You don't have to be the best stock picker ever in the world. You just have to be average. The average return in the stock market has been 13% per annum. You only have to be average. You can be average in the stock market and still make a great amount of money. But you're still afraid, right? I know, I get it. So how do you get over that? Now, the usual advice is to start small. Great advice is to invest in index ETFs. Also great advice. There are some great ones in Australia like VAS, which is Vanguard's Australian Shares. There's also IOZ. There's VGS if you want to invest in international stocks. Just generally, there's some great index ETFs that will allow you to jump into the market, have instant diversification, and they're simple. And because they're an index fund, they'll follow the average returns of the stock market. See, it's great to be average. And lastly, just committing to investing small amounts over time. You don't need to rush in with some big lump sum amount, although that can be great. You just need to invest consistently when the stock market's either up or down. Because if it's up, you buy less. If it's down, you buy more. You also don't need to rush. The stock market is a long game, so you don't need to do it today. You can do it tomorrow, next week, next month, in 6 months. It will wait for you. Time in the market is what's going to make you the most money. So starting today is great, but starting next week is also fine. Next, this is going to get you very excited. I want you to learn about compound interest. Oh, my friend, this is the beauty of time working its magic. Now, I know this is very exciting, but I want you to calm down a bit now. No, literally, I want you to calm down, because to be a great investor, you need to be calm and have your emotions under control. Because investing, I know it's logical, but it's also an emotional game. You're going to have some really wild emotions when the market goes up and when it goes down. You might not act as rationally as you think you're going to. Most people, especially beginners, They want to panic sell when the market goes down, but they also want to panic sell when the market goes up. They want to try and lock in that profit before it goes back down again. You'll start to second guess yourself. You'll start to overthink everything. Stop and take a breath and calm down. You just need to know that market fluctuations are completely normal. And so you need to reframe that. Think of falls in the stock market kind of like a sale. It's just that company's price has gone down. Usually, generally, nothing has gone wrong with that company because we're looking at a marketplace, and marketplaces are based on what the buyer, the investor, thinks that that product is worth any particular day, which is why a company can be completely the same. Nothing has changed within the company, but the price goes up and down over a week, even over a day, based on what investors think that that company is worth and how much they're willing to invest. So when it goes down, you can think of it like a sale. You're getting a cheaper product, or you can just do nothing and just wait it out. Same with rises. Again, very predictable if the company is doing the right thing. And I have to say this for a disclaimer, that past performance is no guarantee of future performance. History has shown that people that keep the money in the market usually make more money than those people who are continuously buying and selling and trying to time the market. That old cliche, time in the market rather than timing the market, is so true. And the research backs that up. So let's say you're not scared, you just don't know where to start. The first step is just realistically making a plan for the types of investments that you want to make. Now, what you buy is going to be different for everybody watching this because everybody comes from different backgrounds, different amounts of money, different ways they want to invest in the stock market. There isn't just one particular way that you can invest. I'm a dividend investor. Some people are traders. Some people are short-term. Some people are long-term. There are lots of different ways that you can invest in the stock market. So you need to work out what your risk profile is, what your tolerances are, if there's a particular type of company that you like over others. And if you don't know the way you want to invest, try out a few methods and see which one you like the best. Like you said, you have time. And if you try one method and you don't like it, try something new. There are many valid ways of investing in the stock market, and the best way is the one that you enjoy the most and that helps you sleep at night. Now, if you're really not sure where to start, just start with index ETFs. They're one of the simplest ways to get started. All the work is done for you, and you're just following the top 200 or 300 companies within the market. Understand that market fluctuations are completely normal and expected, and that investors are real people. So as much as we want things to happen with predictable patterns, humans, investors have emotions and they can act unpredictably at times. Remember that most people focus far more on the negative rather than the positive, which is why the price can fall so much faster than it rises because that fear kicks in. Also understand that there is a lot of luck involved in stock market investing. A lot of people would like to think it's all skill and it's just them picking the best stocks. But unfortunately, or fortunately, luck plays a huge aspect in investing. A company could get a new contract overnight, or technology might change, or there's a pandemic, or aliens arrive, or anything can happen. And so while skill can have its place, luck plays a significant part as well. I know we want to have that complete control over our portfolios and our money, but sometimes we don't. And you've got to be okay with that. That's why when you see those experiments where they pit a really experienced fund manager against someone just throwing darts against a dartboard with companies on it, the portfolios don't do that much difference. So the fund manager is obviously going to be far more knowledgeable on research, on how to look at the financials and interpret those. But like I said, sometimes the market is just unpredictable. And as for practical tips, the rest is easy. Open a trading account. Which one you open really doesn't matter that much. Just make sure that they're reputable and they're easy to get money in and out of. I usually like ones that are attached to your bank, so you can just use your bank account to transfer money in and out of. Makes it simple. Don't get too stressed on the brokerage fees unless there's a huge difference. Mostly it comes down to just choosing a reputable company. Invest consistently and obviously do a little bit of research before you jump in. You want to make sure that the companies that you're investing in are reputable companies that have been around a long time, they have a history, and they're likely to do well in the future. Or you can just go with ETFs, which makes it way more simple. If you are interested in dividend investing like I am, because I invest for the income, then there's plenty of videos on my channel where I show you how I do research. But there are other investors who do it different ways, and you can find out what their methods are as well. And just try out a few methods for yourself and see what you like best. If you do decide to go single companies, the only thing you really need to know is to try and stick with the bigger top companies and diversify your portfolio to manage your risk, because you don't want to be putting all of your money into just one company. That's too risky. And here's my last tip for you. I want you to expect the stock market to go down in 2025. I'm serious. I want you to expect the market to go down. Will it? I don't know. I don't have a crystal ball. But why should you? You know, on average, the stock market goes up over the long term, but you need to be prepared for the years that it does go down. If you actually think that the stock market might go down and you're prepared for that, you're probably going to stick it out for the long haul. You're not going to give up if you don't expect that you're just going to make $1 million overnight. That hope that you're going to be an overnight millionaire and then it doesn't happen is what makes people just quit so easily. And I know you want that hope. I know you want to feel like there's a better future for you. And I know you want to try and control the outcome. But if you expect it to go down and you're prepared for that, even if it doesn't, even if it goes up and doubles and triples over the year, and I hope that it does, but if you're prepared for it to go down, then you'll be able to stick to investing long term. Your odds are great long term, less so short term. But whatever happens in 2025, good luck, investor. I wish you the best of fun on buying those companies. Happy investing.